Hey everybody, Mike DeAndre here. We are coming into the final leg of election season, and it is more important than ever to remember to not get distracted. Okay? We need to remember that in election years, markets are up 75% of the time, and they're up about 7.5%. We want to be focused on what's most important. So let's take a look at the market snapshot and see what the data will tell us about how our assets should be positioned today and in the near future as we move forward in this election season. So if we start with a view of the S&P Total Market Index, which is all large, mid-cap, small, micro-cap, I almost ran out of fingers there, I'd have to drop my pen. Stocks, it's about 3,600 positions. And when we look at this, we see that there is a beautiful series of higher lows and higher highs. The simplest definition of a bull market. We don't want to stare this in the face and be distracted or be sad or be disappointed when all we can do is see the data and align ourselves with it. If we take a look at our custom index, which is offensive versus defensive stocks, we can see that the offense has just put a new buy signal and is back on the field. And we want to be running offensive plays when we have the ball. And right now the market's got the ball in an offensive posture, and we want to take advantage of that. We want to align ourselves with the data, not the narrative. Not the narrative from the media, not from candidates. As a voter, as a citizen, do that. That's great. As an investor, as an advisor, helping my clients, whole different story. Okay. This is a really, really important chart, not just because it features an adorable little baby Kamala and baby Donald playing Jenga and stacking blocks. What we're doing is we are stacking assets, and we want to see and be able to notice that there seems to be a very big difference between the top of the chart and the bottom of the chart, okay? What's really kind of fascinating here too is that this is a long, intermediate, and short-term evaluation. And you would sometimes expect to see a few orange blocks pop up here and a few blue blocks down here. We don't see that. We see a very clean demarcation, if you will, between the winners and the losers in our relative strength rankings. And that's kind of nice because we've been living in this part of the market all year, for actually more than this year. And while the market is concentrated, in fact, it's the most concentrated looking back, over the last 200 years, the top 10 positions of the S&P are about 35% of the S&P right now. That still doesn't mean that other parts aren't participating. We're going to take a look at those in a minute, but just by looking at these rankings, we see that there's a number of asset classes that warrant ownership in our portfolios today. And if we get caught up in this narrative that, this concentration is bad, it's going to hurt me, I'm going to lose money, I've got to avoid this, I should be scared, blah, 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 blah. No, we got to focus on the data. We got to look and see what's really going on underneath the noise and underneath, the television shows all day are great. They're wonderful. They sell a lot of advertising, and they want to put your eyeballs in front of that advertising. But are they there to help you grow your wealth, protect your wealth, keep your sanity? Not necessarily. They're there to keep you tuned in, and that's fine. They have a job to do. We have a job to do. This type of analysis keeps us focused in the right areas. It helps us to see where should we concentrate and where should we avoid. That's very, very, very important. Areas that are kind of cool, things that are breaking out, things that are really interesting. Silver, take a look at this. This is 2024 right there. Huge monster move. Now, silver is not it doesn't play linearly. It's a pretty volatile piece, and you can see how that's been. But man, it's breaking out, and it's been very, very. It's been a very strong performer this year, and we've enjoyed that strong performance. Same thing out of gold. Precious metals ranked very high in our rankings, and we can see again 2024 breakout. And if we've looked at previous videos at long-term charts where we saw that long cup and handle, and we are breaking strongly out of that and continuing to move higher in gold. So if we take a gander at a couple of the stronger sectors and what we're looking for to sort of evaluate how they're performing relative to their peer, the absolute chart is important. Okay, we want to see the short. We see a breakout, we see a consolidation, and we see another breakout. We see that in financials as well, and we see it in technology. A bit of a large consolidation here. We need to see this break above that that previous high. We haven't quite seen that yet, but we're watching at the bottom. More importantly, we want to see this price line above the wave. Okay, and we see that here, we see it here, and we see it just starting again right there. And if that continues, we have every reason to believe that this market's going to break out higher for technology, continuing to perpetuate the growth and bullish nature of this current space. If we look at some weaker areas of the market, we're looking at healthcare, materials, and staples. And you'll notice the chart patterns aren't all that different, okay? It's not about what stocks are making money. It's what stocks are making the most money, or what stocks are outperforming relative to their peer groups. So we see this triangle here, and we did get, we got a breakout there, but healthcare just hasn't really gone anywhere. And we can see based on how it's performing relative to the S&P 500. Same thing for materials. It's not that materials haven't broken out, that we don't have a little throwback and potential breakout again from there, but they just haven't really done much against their peer group. Same thing for staples. Staples isn't a bad looking chart. It's not the greatest looking chart in the world, but it's not a bad looking chart. What's really ugly though is how it's against its peer group. Okay, so we need to be mindful of both postures, the individual chart and how they compare to their peer group. So, oh man, I almost blew right past this. The drama of Donnie and Miss Harris arm wrestling in front of the Capitol. I couldn't have forgiven myself if I just blew right past that. So we're going to look at a couple ratios, couple relative strength charts, a little arm wrestling match, and we're going to take a look first at U.S. versus the world. This has been a very, very strong, robust pattern. It could change. All of these charts, we have to be mindful. We have to be careful. We have to continue to look at them. But they help steer and guide us in our decisions. And even if you can see closely up here, we even have another breakout in this chart. When the chart reacts, when the chart changes, we'll change. But until then, it is what it is, okay? And let's take another look at another one, which is needs versus wants in our discretionary versus staples. And while this on a relative basis has been a little choppy, okay, we got a pullback there, another breakout. And then this sideways isn't bad. It just means they're kind of moving together. In this case, they were both moving up together, which is fine. And then there was a bit of a period here where staples asserted themselves. There was a little bit of a value move in the market, but that growth has continued on. And in some measures, all these indices and individual securities, they have different constituents and different weightings. Some weightings of this wants versus needs have already broken out above this line. This one is very, very close to doing with these two S&P indices. But if we just look at the annual performance, or the performance looking back through 2023 into 2024, we can see a strong gap here between the staples and the discretionary stocks, and it's echoing itself in the ratio chart. Mike, show me something that will help me understand how we can kind of take the temperature of the market, measure the wind, where is the market going, what's happening. Give me a picture of that gauge that we can use to decide, hey, are things moving in the right direction, or are they moving in the wrong direction? Which way should we be positioning ourselves? And this is the new high, new low chart for the New York Stock Exchange and the S&P 500. So what we have here is we have a couple periods of weakness during COVID. We have 2022 here, and then we've got a whole lot of blue here and here. Now, quite simply, when we see those large orange wicks coming down, those are new 52-week lows. Market is weakening, okay? When we see those tall skyscraper looking, this looks like Dubai right through here, right? The skyscrapers in the Middle East, that's new 52-week highs. And what we're trying to do is read the difference when there's a change in pattern between the new 52-week highs and the new 52-week lows. So I've got a couple of studies here. One of them, this is during 2008, okay, where we have a pretty dramatic example of this. But we can see how the new highs, new lows list can help steer us into making better decisions with how to allocate our assets. So we see this green box in here, okay, where we see virtually zero orange bars, okay. We see the run up through 2006 and 2007. Again, that peak, that high was in October of 2007, much before most people, even on the news's radar screen, that there was a problem and that we'd be going through what we went through in 2008. But we can see the new highs list is very, very strong, and then it just falls off a cliff, okay? So if we see this in here, the blue lines, they completely disappear. And if we start tracking it from when the blue lines disappear, and we anchor a volume-weighted average, we see that price quickly gets below that anchored volume-weighted average and never gets back of it for many, many months, okay? And we see an increasing amount of orange bars and a very low decreasing amount of blue bars. Before long, we're in a situation where all of the bars are negative, okay? And this was a terrible, terrible market. And then in the recovery, you see this just very flat, no difference. They're just burning off all of these lows. No one's making new highs yet, and we see this sort of like very flat market, but we see, movement here. And so this relationship of going from all blue to a little bit of blue, a lot of orange, all orange, nothing, and then back to all blue again, helps us navigate through bull market, bull, bear, bull market cycles, okay? We're going to look at 2022, and 2023, actually, this is beginning at COVID, going through to present day, and we see that same example. There's COVID, big drop off in COVID, we anchor, and then very quickly, though, we go from no blue lines, no new 52-week highs, to lots of 52-week lows, and then it just starts to reverse, and we get back into a situation where all the 52-week lows go away, and we just start chewing away back at 52-week highs. We get a huge run up, and then this is a dramatic peak, and then it really falls off a cliff. And that's another way of the market telling us, hey, there's been a really violent move in one direction. We need to be careful here. And we see the new highs really aren't going very far. New lows are starting to pick up, and then we find ourselves coming into 2022. And if we anchor here, we see that fall off below the volume weighted average price. Lots of new 52-week lows, and then we watch it reverse itself back over here, and then again those blue skyscrapers come back, the orange new 52-week lows go away, and this is just us watching from one simple metric, not the only metric obviously that we're looking at, but just from one simple metric, we're watching the ebb and flow from bull markets into bear markets back into bull markets, okay? And if we zoom in and we look at where we are right now, we see the remnants of 2023 coming into 24, and we see the strength. We see the strength in this marketplace, and even today, the last few days, actually this is a weekly chart, the last few weeks, we see very little new lows, barely even visible, and we still see really strong new highs in both the NYSE and in the S&P 500. So it is super critical that we stay focused on the right things. We're positive on the data. I don't even want to say that we're positive on the data. We're positive because of the data that we're seeing right now in today's marketplace. Could it change? Are there other areas to be concerned about? Are we spending too much as a country? Yes. Is our national debt service outrageous? Yes. Is inflation fully gone? No. There are issues, but when it comes to the securities that we own and the way that we're positioned, and we go back and we look at those relationships of how should we invest today, we have to focus on the data as it is and continue to allocate towards that strength and away from the weakness. Vote. Have a great week, and we'll chat with you soon. Take care.